Hey, welcome back to Everyday Economics. This is the podcast that helps you learn about the economic world happening around all of us every day. I'm your host, Chris Krug, publisher of the Center Square. Everyday Economics is brought to you by the Center Square. We're recording this episode on Tuesday, February 17th, 2026. And joining me as always, my friend and colleague, Dr. Orphe Divounguy. Dr. O, obviously you spent a lot of time looking at the housing market, thinking about the future direction of the housing market. I think, to not put words in your mouth, but, you put the key in the ignition, you turn it on and check engine lights, for the housing industry right now. What are the biggest issues? Let's focus on existing home sales first and the housing market overall. And then let's spend a little bit of time on what, builders are thinking and what's the direction for the balance of this year.
What motivated me in thinking about this was the fact that there's a famous economics paper, in the economics literature, right, that entitled "Housing is the Business Cycle," right? And the case is that, the residential investment, despite being 4 to 5% of GDP, punches far above its weight in driving recessions. Declines in residential investments preceded 8 out of 10 post-World War II recessions, and contributed disproportionately to GDP contractions in the quarters leading to a downturn. And so if, in fact, housing is this leading indicator, this flashing signal for where we're headed, then housing is basically flashing yellow.
Yeah. Okay. Specifically about, all sales of homes and the rental market, really anything that has anything to do, with the industry on the consumer side.
Yeah. The bottom line is existing home sales started the year down 8.4% in January. 4.4% lower than a year ago. And by the way, this is seasonally adjusted. And so, even if you consider the holiday seasons, Christmas falling on a Thursday or Wednesday, whatever it was, and a deep freeze in January. Yeah, of course, a deep freeze in January played a role in delaying people foot traffic and people going to look at homes, right? For sure. And it's probably happened not just for existing home sales, but also for builders. First, it delayed, any completions, construction, the flow of construction activity. And it probably delayed foot traffic, people going to look at new homes. And so, yes, the deep freeze had something to do with it. But ultimately, I think the labor market sentiment, this crisis of confidence is what I call it, is having a lot to do with it, right? The majority of Americans say it's harder to get a job. And we know a major reason people move is for a new job, right? You're getting a new job, you move. Maybe your family is increasing, the size of your family is increasing, and then you look for a new house and you move. But a new job is critical. And your future income prospects also very critical. If I don't feel like I'm going to be okay in the future in terms of my steady employment and incomes, it's unlikely I'm going to go out and take on a mortgage, right? And it's unlikely I'm going to go out and take on new debt, right? To go in like a big chunk of debt, because that's what a house is, a big, right? A big mortgage. It's unlikely I'm going to make these big commitments. We see in the labor market, business owners are not hiring. Hiring is a big investment in somebody, right? And so hiring is down. Hiring's been down for a couple of years now. The number of job openings is 15% lower than the number of job seekers because job openings have been coming down. And so these big decisions, people are not making them, whether you're a business owner or a seller, a potential seller, a homeowner, right? You're not thinking of moving, or you're a renter. Renters are staying put. You look at tenant retention rates on the rise, renewal rates. People are staying put. Renters are staying put. When you combine that with the increase in the number of vacancies from the supply, the construction supply that we got during the pandemic, the number of apartment buildings that came on the market, vacancies are increasing, and that's pulling rents lower. In fact, I look at the Zillow forecast, and rent growth for multifamily units expected to move sideways, basically stay flat in 2026. That's rare. And at the same time, single family rents are expected to move lower from, to end up roughly around 1.1%. If you think about it in context, before the pandemic, rents were increasing at anywhere between 3% and 5% each year. So rent growth at about 1.1%, or, between 0% flat and 1.1% is very uncommon, right? And it's a combination of more supply and less demand. If you add the fact that there's fewer people coming into the United States, right? Slower population growth. Well, that's also a headwind for rents, for people in the rental space. And so you have all these factors, at play that are pulling, rent growth lower. And so that's kind of where the housing market stands right now. Now, of course, we don't expect a recession yet. I don't expect a recession yet. I also expect there's going to be some fiscal stimulus in the first quarter of this year. So that might actually be supportive. And so the baseline forecast is still for an increase in activity in 2026. But there's a major downside risk, and it's going to revolve around the labor market. If the labor market cracks, all bets are off.
Yeah, I mean, certainly there's contingencies here, right? I mean, in the meantime, I saw the note from your post at LinkedIn regarding the National Association of Home Builders, and the builders are cutting they're cutting prices. 40% are cutting prices. 65% reported using sales incentives, and some of those sales incentives are like, we're talking like 6.5% up to 11%. Based on what you had reported.
Yeah, up to 14%. Lennar, this in Q4 2025 reported 14%, right? So you're looking at, $50,000 in some cases, given to the buyer in closing costs and rate buy downs.
Right. This is not going to turn around quickly. I mean, certainly until the Fed makes a decision on St. Patrick's Day. I mean, I think we're probably going to be looking at a picture that doesn't change a whole lot. You and I will stay with this story, and we'll spend time with it, certainly here at Everyday Economics. So thanks, Dr. O. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever great podcasts are hosted. Read Orphe's column each week in the Center Square, and make sure that you listen to Orphe and me every weekend on the Center Square Radio Hour.